Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Matt Forrester, Chief Investment Officer with Lockwood Advisors at BNY Mellon Pershing. Matt, it is great to see you as always. Welcome back to Trade Talks.
You're welcome. Good to see you.
And markets have had a strong uptrend since mid-October. Matt, what do you think has contributed to that?
Boy, they sure have. I mean, I'm not sure how many people realize that ETH is up 27% since the end of the third quarter. The industrials and the S&P 500, also up meaningfully, well over 12 to 15% plus. Even the Nasdaq has contributed, not as much, but just really strong market moves since mid-October or late September of last year. Quite a lot of reasons for that. We've had better inflation data, which is something the market is very much focused on. We've had better hard data on the economy. The soft data looks a little worrisome. In fact, I think it's starting to signal some of the real slowdowns or potential recession, meaning the survey data, those kinds of indicators are really weakening up. But the technicals, short selling has really had this market moving higher since the end of last year. And of course, the biggest one might be that the investors have a real faith that the Fed is going to pause and then pivot on rates. And we'll learn more about that, of course, tomorrow.
Yeah, well, it is opportune timing to have you on the show just before the rate hike decision. What do you expect to hear in terms of messaging from the Fed?
Yeah, so look, obviously the inflation numbers are starting to cooperate. We'd remind everybody that the Fed has never paused a rate tightening cycle or ended their rate tightening cycle before we've seen a real Fed funds rate. That means a Fed funds rate over inflation. That number right now is 6.5 and coming down. So, to me, the terminal rate of 5.25 or so doesn't look unrealistic, but markets expect they're going to pivot before then. So we suspect tomorrow that the Fed will deliver more of a hawkish tone. Doubt that the markets are going to like that a whole lot. They're likely to do that in a number of ways. They can keep the language in that talks about ongoing tightening or ongoing hikes in rates. They can signal that they're going to stay committed to the terminal rate through the rest of 2023. They can influence that in the next meeting. Of course, we'll get the dot plots. So they've got a number of ways that they can use the language. I think the markets will be very sensitive to the language that they use tomorrow to indicate what the policy might look like for the back half of this year. But we've probably got a couple more rate hikes to go, and I think the market's expecting to hear a different tone with the Fed. We doubt we're going to get it this soon.
So, Matt, do you think we'll have to pay a price for declining inflation?
Yeah, that's the real interesting part. We're going to get a number tomorrow. We'll get a JOLTS data. You've heard the Fed talk about this notion. They don't use the language of the beverage ratio or the beverage curve, but it's this ratio between job openings or JOLTS to the actual number of unemployed. We're going to get a new JOLTS number tomorrow. And I'm interested to see whether the job openings, to continue to decline a lot as the economy softens up. But the Fed is talking about that, and it's looking at these labor market indicators as well as the CPI. But all of this comes together in this notion of the price that we have to pay to get inflation lower. We might call that something like a sacrifice ratio. So the U.S. economy has had a sacrifice ratio around 1.5, maybe 2 points between those over the last several decades. So it means for every point that we want to get inflation down, we have to sacrifice somewhere between 1.4 to 2% on GDP growth. Well, that doesn't leave us a lot of room. We just had a 2.9 print, which is a little stronger than people expected, primarily due to inventories. Inventories was half of that build in the output for the fourth quarter last year. And that doesn't give us a lot of room to try to get inflation down without meaningfully impacting GDP. The soft landing scenario has always been a little bit of a myth, and I think we're going to start figuring that out as the year goes on, that it's just a very difficult thing to actually achieve.
So then is there too much optimism priced in the market?
Yeah, I think there's a couple of ways that there's probably too much optimism. We'll give you one, and again, this is going to be very much talked about tomorrow. But at the moment, Fed funds futures are showing something like 200 basis points of easing in Fed funds from June of this year to the back end of 2025. So it's almost 200 basis points. it's probably too much. The Fed is probably likely to stick to that terminal rate for longer. We believe. Also, we're just starting to see, as companies are reporting through this earnings season, we're starting to see the earnings in the end of 2023 really start to deteriorate. They've already come down from 235. Now we're under 225, so we're probably around 223 or something like that. And we've seen that number swing from something like plus 12% to -5%. So we're seeing some real declines in those future earnings numbers, and that's the one that we really have to watch, because we're still at an 18 multiple on a 220 some number for the S&P 500. That's just too high, probably, for the macroeconomic scenario that we're going into. And that's where we start to get concerned that the multiples just might be a little too rich on equities, particularly in the US.
All right. And finally, Matt, how are you managing portfolios with this backdrop?
Well, I can hear by the way that we're talking, we're still pretty cautious on the outlook for the year, much more constructive on fixed income. We've gone from a -1 real yield in bond market to a 2+ positive real yield on bonds. So they look much more attractive. Equities, we still have some hedges in place, and we're still, maintaining that cautious tone as we go into the back half of the year.
All right, Matt, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.